While ringing the bell attracts headlines, let's be honest, years of hard work and preparation are the pillars supporting successful transactions, whether it's IPO, sale, or otherwise. So the panel right now is going to cover leading practices for businesses preparing for the next stage of growth, begging the question, are you prepared? Well, let's meet our fabulous panel. I'm going to get them to introduce themselves, and I'll start with you, Demet.
Thank you, Mark. My name is Demet Özdemir. I'm a transaction advisory services partner within EY. Istanbul is my hometown, if not traveling, because I do have another role in the firm covering, I'm the growth markets leader for Europe, Middle East, India, and Africa. That means I am looking after the entrepreneurs, all high growth companies, including transactions, IPOs, and PE/VC backed.
Do you find very big differences across the different countries and the different mini regions?
Oh, very much, because my responsibility in EMEA includes developed markets as well as emerging markets, India, Africa, and some others as well. So totally different
right.
than each other, and not to mention the differences between the countries as well, economic, political, cultural differences.
But in the end, every entrepreneur is after the same thing when it comes to the transaction. What's the best value for both sides? Great. Thank you so much for being with us. Scott Collins is here, Managing Director of Summit Partners. Tell us a bit more.
Thanks, Mark. Summit Partners is a growth equity investment firm. We make investments in privately held businesses, generally entrepreneurial-owned businesses that are growing fast and are already reached a point where they have substantial revenues and usually profitability. We've been around for about 31 years, and we invest globally, but we have offices in Menlo Park, California, one in Boston, and one in London, where I'm based. So I'm American, but I've been based in London for the last 15 years or so. And we invest in a whole variety of different sectors.
When you look at the market as it is right now, when you look at the organizations coming to market now, how does it make you feel? Are you feeling good about the industry? Do you feel negative? Where are you?
I generally feel good all the time. I mean,
and now on to business.
every period has its ups and downs, but I'm an optimist by nature. I think most entrepreneurs are. I think it's generally always a good time to be building and growing a business, and but I do think the market environment now is a pretty good one to make investments.
All right, excellent. And of course, a return to the stage for EY's very own David Brown.
Hi, David Brown. I'm the America's Equity Capital Markets leader. I work with both private and public companies that are evaluating capital raising strategies in both the public and private markets.
All right, so we have a wonderful audience, an intimate audience, I think we can agree, in front of us. So what we're looking for is words of wisdom and advice. And why don't we start with timelines? Because as companies contemplate theoretical transaction timelines, at what point do you think readiness evaluations should be prepared? Give us some idea on how far ahead from the actual date of transaction organizations should really be thinking about this and getting themselves ready. I'm not sure who wants to start, but it's a free-for-all.
Okay.
Demet.
Looking at all the markets, as we just spoke, they're a totally different environment. However, there's just one commonality, which is growth. All our clients that we speak in every market is speaking about achieving a growth. So the strategy of the companies is growth, and transactions is one of the ways to achieve this growth as well. So looking from that perspective, where the company is currently as a situation versus where they need to be in order to be transaction ready is the driver for defining the timeline. So depending on the steps that needs to be achieved before becoming a transaction-ready company, will be determining the timeline that the preparation needs to start.
Can you give me a band? I mean, what are we talking about here?
Well, I would never guess less than 6 months, definitely. But on an average ballpark, I would call it like 12 months on an average for speaking about a transaction and completing that, but it can stretch beyond 2 years.
Wow.
If we are talking about, for example, a publicly listing in another jurisdiction of your home country as well, which requires, we may speak about it later on, but which may require additional steps to get it ready.
Got it. Scott, if a company was taking 2 years to come to market, would you think that was long, about right? What's your opinion?
No, I don't. I think that's not a, I think that's a reasonable amount of time. I actually think this preparation starts day one. As an investor, we're obviously both buying and selling companies. We actually we look a bit suspiciously on companies that are preparing for a transaction. What you want to invest in is a business that's a solid company, and many of the things that you're trying to get ready for in a transaction are the kind of things that high quality businesses just do.
Right.
They don't do them when they're getting ready for a transaction. They just do them. So governance, depth of management team, quality of financial reporting, to name a few, are the sort of things you should be doing day in and day out, whether you're getting ready for a deal or not. Now, obviously, there's another category of things, it's probably where the question's coming from, that are specific transaction type things, particularly for an IPO. The Sarbanes-Oxley preparation and certain things that you just probably wouldn't do unless you were pretty sure you were going to go public. And those things, I think, you start really, zoning in on a year or so in advance. But I think a lot of this is just good company building and shouldn't be necessarily tied to a transaction itself.
No, I think you make a very valid point. And I suspect, David, a lot of organizations, for them, readiness is actually, it's a mental, behavioral, cultural thing within the organization. Because if they're doing everything right, they are theoretically prepared.
Yeah, I mean, it's a transition. And the one thing I would add to that dovetails with the question are just, senior management hires, right? So it's one thing, I agree with everything Scott said, that you want to increase the depth of your team, whether you're going public or you're selling or not. You're just building a better business. But there are certain roles that you really can't get away with in the public market that you would need to add, and that's part of the culture, right? That's investor relations, that's a public company CFO, that's more than an internal finance person. You might have the best internal finance controller, the best management for a private business, but if that person hasn't spoken to the public market before, you need to think about that. It doesn't mean you need to switch, but you need to consider it.
Right.
And that's time. You see a lot of companies kind of go through the process and then drop their public company's CFO in 3 to 6 months before the intended deal. That's difficult for the CFO, that's difficult for the market. I think it's important to consider these things ahead of time, and that's where I think you get into the 18 to 24 month timeline, where if you are considering going public, and wrapping into your question, you want these people to be, these management team members to be integrated into the fiber of the culture change that's going to happen with the public.
It does take time. And you're right, because people examining the operation will see these things have only just happened the last few months. We no longer understand what this company is. We need more time. Okay, we're going to talk also, of course, about the options we have as an organization looking to the future, looking for growth, what type of transaction it might be. But right now, from your experience, all three of you, what areas do you think are typically the most underdeveloped at growing companies and require the most work? If you're going in, you're saying, okay, where do we need to bring things up to speed? And I got some choices written down: systems controls, IT, HR, compensation, forecasting, tax. I mean, what is there out there? Is there a commonality, Demet?
First of all, I wouldn't differentiate one or the other one. It's all of them. And
all underdeveloped.
All underdeveloped ones. Just because, speaking from a financial standpoint of view, all the financial statements, being the reporting systems, should be ready to be able to either publicly listed or to be a transaction-ready company. Going to tax risks and exposure of the company for the transaction and post-transaction is another aspect that needs to be considered. IT, all the systems underlying the whole organization is important, should be ready. So what else? Talent, HR. If we're talking about an entrepreneur-run company versus a family business company versus a real institutionalized company, aspects are different. So having a professional management at the key important layers of the organization, it is very crucial to have that professional management in place. So that requires a readiness as well.
Of course. And we're actually going to come on to the importance of the management team in its current state in a moment. But Scott, when you're looking at a situation like this, Isn't one possible enemy of progress the search for perfection? Trying to be 100% ready, you'll never get there.
I think that's right. The two areas I was going to mention were depth of team and I would say financial controls. Those are the two areas that we see most underdeveloped. And I do think, entrepreneurs, they need to make trade-offs. They can't do everything right all the time, and you need to prioritize. One entrepreneur that I worked with, I'd always be pressing for something that I think really is important for every company, which is to have great monthly financial reporting. Every month be able to produce your income statement, your balance sheet, and your cash flow, and some KPIs, and have that come out, hopefully between the 15th and the 30th of every month, and just do that like clockwork. And he would say, yeah, but if I don't have a product and I'm not selling it, there's not a whole lot of things to account for, which is also correct. But I think which is maybe more correct, right? So you can't do it all right from the start. But I really do think many companies undervalue the worth of strong internal financial reporting. It will pay dividends in spades when it's time for a transaction, whether it's a listing or an M&A event. And it's the sort of thing I think that many businesses think that they can kind of put in place later and get it right. But it takes a long time to put it in place and then to operate it and make it work properly.
Scott, do we know as business leaders if our internal reporting is strong enough? It's a label you say, strong internal reporting, strong financial reporting. Do we know if it's strong enough?
Well, I suppose you can get advice from your peers, from folks like EY or some others from a benchmarking standpoint. But I think I think at a minimum what I just said in terms of being able to produce your income statement, your balance sheet, and your cash flow monthly with the relevant KPIs. That a lot of businesses don't do that, and I think you really need to be there.
I'm guessing, David, I'll come to you in a second, Demet, but I'm guessing, David, that people in the audience are going, yeah, we do that already. From your experience, what have you found that maybe needs a bit of zhuzhing up?
From an IPO perspective?
Or really preparedness for any transaction. An organization comes to EY and says, look, help us, give us some advice, what do we do? You look at their setup, you look at the organization. Typically, what are you finding from your perspective that perhaps needs a little bit of extra?
I think it's underinvestment across a lot of these different areas. You think about the potential return in these areas, like Scott's talking about. Let's just say financial controls, and you're worried about the additional costs of an additional headcount or two in your finance division, if that's what ultimately fixes it, or bringing on an SEC reporting person or two, if you're ultimately going to go public, it seems like a lot of cost. But if that's a lot of cost to you in the whole scheme of things, you're probably not at the scale to go public. The return on those types of investments, when you think about what would happen to your stock price or your acquisition price if you're in a process and you can't hit the numbers that you've budgeted.
Yeah.
So in a sale process, if you say you're going to do $30 million of EBITDA, and when they come to due diligence, they realize that it's going to be 25, and that's something that you could have controlled.
Yeah.
Or in the public, and that's going to have a precipitous hit to the value that they're going to purchase you for, not just because of the fact that EBITDA is going down, but your inability to predict that happen is going to be a problem in the public market. You're talking about 20, 30, $100 million hits when you miss a number out of the box. That's extraordinary relative to whatever it would cost to improve your control.
But that's interesting that it's not just the fact you missed the number, it's the fact that you weren't able to forecast, you weren't able to fully see what was going on in your organization.
I would say that's a bigger deal than the actual numbers. I mean, you can there are all sorts of seasonal reasons and all sorts of one-time issues in businesses that can cause fluctuation. But when the business can't explain to you, the buyer, whether the buyer is a private buyer or the public buyer, why that happened, that's a precipitous fall, and it erodes confidence. And all of investment is about confidence in the management team.
Absolutely. We'll come on to the strength of the management team. Demet, I know you had your point, and then I'm going to come back to you, Scott.
I just wanted to emphasize one thing in terms of doing transactions in less developed countries, like emerging countries, including my home country as well.
Yes.
So the financial reporting systems, I fully agree, is very important, and the quality of the financial reports is very important. And in many parts of this less developed countries, we do have a transparency issue. So that needs to be taken into consideration while assessing the readiness.
Thank you. Scott, there was a comment you made earlier, and I didn't pick you up on it, and I should have done. You mentioned the depth of the management team. I don't want to talk yet about the quality, or indeed the perceived quality of the management team, but what did you mean by depth? Can you define that for this audience?
Well, I think growth businesses go through various phases, and we often call it management infrastructure, but businesses can get going and be quite successful on the backs of a handful of highly talented people. And as that business grows, you go through some step functions where you just need to change the way the organization is structured, change the levels of responsibility, begin to put in some more formalized, not rigid, but at least formalized communication structures. So instead of this handful of people that just sort of intuitively seems to know what everyone is doing, you maybe have a group of 10 or 15 who need to work together in a different kind of way. And I think many businesses that we invest in the stage that we invest, are going from that first, scenario to the second one, and that's where I see, again, a lot of developmental need.
All right, lovely. Now, if you're listening to this content and you're thinking to yourself, actually, I do have a question about that, jot it down. We are going to try and open the floor to questions. So far, and it's been very quiet from the audience because you're deep thinkers. But if you have a question, write it down. Be ready. We'll open it up very shortly. Okay, now let's talk choices, because everyone has a choice. And most growth companies are faced with the decision of pursuing either, I guess, a capital raise or indeed selling the business. Now, EY did a recent survey, and it showed that investors are actively considering the merits of both markets. But I want really to look at it from the perspective of the companies indeed. How should companies evaluate the merits and considerations of both of these paths? As an outsider, I've always thought that an IPO, while very valuable, there must be so many headaches, there's so much compliance, but I don't know. I would love to hear from you. So I'm going to start with you, David. Choices.
I'll start with what I think companies should not do, and that's to evaluate a market and in its current state. Like so many companies, when they see a hot IPO market, they then hurry up and try to go public to hit that market.
Right.
I mean, by definition, that market will be different by the time that company is ready to go.
Especially if it's taking 2 years, right?
Some companies try to jump that process, and I think that's the problem. I think it's all about your transaction rationale and why are you doing what you're doing. And does an IPO make sense? Is an IPO the right strategic alternative for you? What's your rationale? Why are you doing the transaction? Is it just for a capital raise? Is it a liquidity event? Is it a branding event? Is it a shareholder? Is it your employee compensation issue? I've taken companies public before that the only reason they went public, they did not need to go public. The only reason they went public was to create a shareholder, an option pool for their employees that were being recruited away from other public companies that had a liquid currency. It's less of an issue these days with the liquid private markets that have developed, but there's still a discount to those shares, and so you see. But
that was a relevant reason. You see that as a relevant reason?
It was absolutely. It made a lot of sense, but it's different. So the point is, that company, irrespective of the headache of going public, irrespective of whether they needed the capital or not, that was a deal that needed to happen, or else it was going to erode the pyramid that they had built in employees. And there are other companies that will talk about something just something intangible like brand, right? They say, I don't need the capital. My employees are fine. I want the branding event. My customers still say, who are you? And I want to be able to point to a public ticker. I'll trust the company in that judgment as to whether that's worth the value or not. But I do think, there's something to be said for, I'm not sure which path I should go down, so I'm going to prepare for everything. And when the time comes, I'll dual track it. When the time comes, I'll treat the IPO seriously, which is important. I'll treat the sale process seriously. And we'll go down this process, and wherever the best value proposition for me and my shareholders is, that's the path that we'll pursue.
Right.
There's value in that, but there needs to be transaction rationale. And oh, by the way, the IPO is the first transaction, right? People talk about an IPO being a path to liquidity for insiders. Scott, I'm sure will give you a lot of stories where that's the first path, and the liquidity doesn't come in 6 months or 12 months. Mm-hmm. You can get stuck with those positions for a long time, which is fine, but it's important to just mesh the rationale to the realities of the transaction path that you choose.
Got it. Scott, I'm coming to you, but one final question for David, following up what you said. If one of your fabulous clients comes to you and say, we're going to dual track and we're going to wait to the very last second, then make a decision, what's your advice back to them?
Well, on dual tracking, I think our primary advice is the IPO track needs to drive the transaction. If you try to fake the IPO piece of it, you hear clients all the time, good companies all over the world say, well, we think we're a better sale candidate, but we're going to run an IPO track to create some tension in the price. Investors, strategic investors, PE firms will sniff that out quicker than you would believe, and then it's not, if your M&A value is here and your IPO value is here, and you're trying to build to a premium value with that, it actually will go, your level will go down.
You lose the integrity premium.
Absolutely, and so it's not that is our primary advice. And then past that, we've seen companies. I worked with a company a year and a half ago that literally took the dual track down to the pricing call. So usually these decisions get made when the prospectus comes out. Sometimes they get made right before a company goes on the road, where they show what the valuation on the cover is going to be, and they say, do you want to take this is where we're going to go to the public market at. Can you hit this number or whatever adjusted number or not? And we've actually seen companies go on the road, finish the road show, be walking to the pricing call, knowing exactly where the deal was going to price, and they call the company back and say, all right, now for real, we have this number is now real. It's not just a marketing number, we have it. Are you at your number or not? And I've waited on hold on pricing calls and had that come back that we're selling the business. So I think when you diverge is really about what you're trying to achieve, but it's critical to have a real IPO process with proper readiness and proper management team. So if that's the right track, that you ultimately do pursue it.
All right. Scott, what's your opinion on the choice that's available?
I think it depends a lot on the constituency that we're talking about. And I'm going to try to answer the question from the point of view that I think might be most relevant for this group, which is the entrepreneurial owner of the business, the one who's probably the CEO or senior management team. This is like choosing, apples and oranges, because a sale is an exit event. You're selling your business. You're getting out of the business. You're hanging it up.
You're all done.
You're deciding that you no longer want to be independent. You will either work for someone else at this point, which for many entrepreneurs is not a path they normally choose, and often, many cases that we see, that becomes a situation where the entrepreneur will join the acquired company and then do a transition period of a year or so and then exit. Right. So it's really about ending, the entrepreneurial experience and really having the company be part of something else. There's many entrepreneurs who aren't ready to do that yet, and think there's a lot more running room to go. Then, financing becomes a more interesting, whether it's a private financing or public financing, becomes a much more interesting path.
Because then you're still in the game.
Still in the game. I think the IPO is not an exit event. The IPO is a liquidity creation event. It's a financing event and a creation of a public market for your securities, but it's not an exit event. And I think a lot of this has to do with one's time horizon. It's very hard to list a company and then think, well, then I think I'll probably retire in a year or two. You've got to be in there working and committed to that business probably for another 4 or 5 years before you could actually hand it over. So I think that's a consideration as well. So they're really two quite different things. And if the idea is, my company's worth a lot, I want to cash in, I think we're at a good point in the cycle, and I'd like to get what I can for it. Going public is not the answer. I think selling the company is the answer.
But I mean, in reality, you're an investor as well. You acquire companies. If a company says, we want to sell, theoretically, the management team are making the decision, looking at the market, looking at the world, going, this is probably the best it's going to be for a while, because they're not sitting there going, this is going to be worth so much more in 5 years, let's sell now. They're not doing that, right?
When a management team comes to us and say, we think it's time to sell, that's a call we take very seriously, and very, very rarely would we ever try to do something different, because they have a sense of what's happening in the market and with the company.
Wonderful. Now I know you've got questions from everything you just heard. Have you written them down? Good. I'm coming to you in just a couple of minutes. I've got one more of my own. So in a recent EY survey, which are always great and come up with some fabulous insights, investors were asked to identify the most important factors that they consider when investing in a company. And they identified strength and credibility of the management team as far and away the most important factor. Number one. So my question is, as a growing organization, how do you even know that you and your team are in fact strong and credible? What's the measure? Who would like to answer that? Demet, do you want to start, or should I throw it over in that direction?
I can. Professional management is very key, especially also in an entrepreneur-owned and run company as well. And because of the corporate governance, because of having the organization structure in place is very important. It is important for not only for the profitability, but also driving the growth and the sustainability of the business. Because transaction, not only preparing for a transaction, but post-transaction as well, is a process that shouldn't be underestimated at all. And therefore, it may distract the management from their daily operations significantly due to many responsibilities going on related with the transaction as well. So if the company does not have the right management in place, in the right talent, in the right work streams, then it would be really painful to manage the concentration on the operations as well as managing a successful transaction.
Very nice.
And then post-transaction, also whenever the buyer comes in, which I experience a lot, even though the company sells the shares, the professional management, including the CEO, key management, are asked to stay in the firm for a couple of years, especially the C-suites.
And that's so often the deal, isn't it? That the management people selling the organization do tie themselves to its ongoing success under its new ownership or in its new structure for at least a couple of years. Scott, what are your comments on the strength of a team?
Well, one of the earlier panelists, I think it was the banker from Credit Suisse, had said that we hope that everything goes upward to the right, but we know there's going to be some of this along the way. And I think the strength and integrity of the management team is what carries you through when things are going like this. It's when times are tough or decisions need to be made quickly, and you need to react to changing markets or circumstances. That's really when the strength of the team comes into play. So we take it quite seriously when we're evaluating businesses. I think, how can you do it? Certainly people who have been there and done it before, so people who have multiple instances of success in building and creating value as opposed to first-timers.
Right, that always helps.
It helps, although there is, obviously a first time for everything. We do a lot of reference checking. We talk to a lot of people in an industry about the teams.
About the personalities, about their history, about the way they run business.
Yes, and customers, and talk to their customers and ask, how are things. And you can we certainly don't do this in every business, although we recommend it even after we're an investor. There are actually some pretty good services out there that do evaluations of management teams, who have a structured way of looking at an organization and evaluating managers in a constructive way. So it helps teams improve themselves, and you can actually find people who specialize that as well.
So are you saying that you're a company, you're planning, you're preparing, you could actually retain one of these teams to come and examine you and your team?
Yes.
And tell you where investors might have a problem?
Yes.
That's very interesting. Let's take a pause in proceedings, and let's see if any of our audience will ask a question. Now, by the way, I didn't mention this before, there is a prize for the first person who asks a question, and the prize is, you ready for this? Free coffee while you're here, literally until you leave. It's an amazing prize. It's worth a lot of money in Starbucks value. So, is there a question? Yes, madam at the back. Over to you. Thank you.
Well, thank you. I just was in a privileged position, just sitting
next to the microphone.
Yeah, that's true. My name is Elena Tarasenko, and I have a question related to the recent case study. We all know what happened to Total. And following blast of Deepwater Horizons, there was a class action against the company and its CEO. And the allegation of that class action was that Total was promising to their investors that the company would be risk-averse and their risk management procedures would be of highest level. However, at the same time, they are to deliver high profits to their investors. In reality, as the lawsuit says, Total didn't deliver on promise of being enough risk-averse. We know all that nowadays it's very risky to be absolutely, totally risk-averse. And this is the most risky position to be in nowadays.
So go on, what is your question?
The question is how to avoid some sort of allegations like Total had if there is a totally unexpected event.
Okay.
Like a blast.
Okay, well, thank you.
We should prepare documentation, prospectus, annual reports better, or to embed better culture, risk-averse culture within the companies.
Okay, well, I'm going to stop you there because of time. But thank you, Spasiba, for that question. Rather than talking about a specific case, let's be general. How do we go about making promises and being sure that we won't fall behind on those promises and face action of one sort or another? David?
Under-promise and over-deliver kind of drives everything: risk, value, performance. There's always this question of value when you get to a point of a transaction when you're selling or taking a company public, and every dollar that you under-promise is theoretically hitting your valuation.
Yeah.
I just think it's very important for certainly in a going public scenario, to think about the implications of over-promising and the value hit versus what is really just kind of a next step financing.
Right.
In a sales process, sometimes I can get taught, I could defer to Scott, but a lot of times that'll get tied into an earn-out, so to some extent both parties are protected. But I think that the promise that whether it's over-disclosure, a conservative bias, I think is important, but I think the point was also made, you can't be completely risk averse. You have to be able to take some risk and chance in building a business.
And sometimes it's the wording, isn't it? Because if you promise 100% totality on something, you know you're going to fall back. But if you are smarter with your wording, Scott, you're safer, right?
Well, I think risk is a good word, not necessarily a bad word. I think without, there is no chance for a strong return without risk taking. That's just how it is. And I think the question, I think that was the point that the person who posed the question was making. I think communication around specifically what risks the business is taking and what the foreseeable ranges of outcomes is helpful, so investors and partners and constituents can understand what they're getting into. But I think we all have to take risks in our businesses, otherwise we're just not going to grow.
Got it. Now, time is against us, amazingly. We have one more question. Madam, promise me it's got to be 2 sentences and no more. And we'll get a very quick answer from one of you. Go ahead.
Hi. I haven't heard anyone talk about a board. I think for an entrepreneur to actually go into a listing, they have to get their head around having a board, being a board member myself.
Right.
And the quality of the board, it's not just about the executives. Just wanted some comments on that.
The role of the board, how important? Who would like to go for that one? David's put his hand up.
I'll just add one thought there. I think oftentimes people, like you said, entrepreneurs review that as a requirement when it's actually kind of an opportunity to increase your business profile, whether it's strategic, whether it's financial, it's helpful. And we always see companies we're always showing companies from our governance perspective what the minimum requirements are. And the timelines, the latest you can do these things. I'm always amazed that companies will add board members as they go public or very late in the process, as opposed to getting the value from that earlier on. You can still figure out ways to control your board, and for an entrepreneur, there are ways to have even in a public setting, a controlled company exemption where you can still maintain control of your board and decision making. But I think adding to your board is a real opportunity.
Nice. Thank you for that answer. Very briefly, Demet.
In addition to executive boards, I just want to add the importance of the advisory boards as well. Speaking with different entrepreneurs in different markets, I understand the entrepreneurs really value the advisory board as well in terms of certain needs in order to get the guidance and go to person.
Very nice. Thank you. Given time, I'm going to go for a final word. And actually, Scott, seeing as you're our guest and a non-EY, I'm going to give you the final word. You have an audience of people who are interested in the transaction market. What are your final words of wisdom as we look ahead to the rest of 2016 into 2017? Anything you'd like as a parting thought?
My parting thought is just build a really solid, well-balanced company, and you'll have all kinds of different transaction possibilities.
What wise words. Ladies and gentlemen, a big thank you to our panel. Thank you, guys. And you guys can actually head off in that direction. Thank you so much. Excellent.